Welcome, and thank you for joining our Basel IV webinar in partnership with Marcus Evans. Before we begin, we'd like to introduce ourselves. Monocle is an independent management consultancy with nearly 20 years of international experience. We specialize in providing bespoke solutions to banks and insurers. Our specialist business domain knowledge and technical skills allow us to bridge the divide between stakeholders' needs and the complex systems, processes, and data that our clients rely on. We categorize our services into 7 key capabilities. They are finance, risk and regulation, business change and cost transformation, market conduct and compliance, data and technology, digital enterprise transformation, financial markets operations, and customer centricity. These capabilities allow us to provide our clients with the best in-class solutions across a broad range of finance, risk, treasury, and compliance requirements. With offices in South Africa, the UK, and the Netherlands, we are well positioned to support our clients internationally as a preferred execution partner. We are passionate about the change that we are able to deliver for our clients who operate at the heart of our economies. Monocle, we design change.
Welcome once again. So thank you so much for joining today. And before we begin, I just want to quickly run through a few housekeeping items. As you can see in the bottom of your screen are multiple application widgets. All the widgets are resizable, so go ahead and resize and make sure that you get the best out of your screen. Just a quick one, there are a few resources that have been added to the resource list, so we encourage you to go ahead, download resources, and make sure that you have that in those files. Any questions with regards to resources, we do encourage you to contact the Monocle's team, just to make sure, and I'm sure that they will come back to you quite shortly. With regards to today's event, we also have a few polls for you, and we have a survey that has been posted there. So if you can go ahead and answer that quick survey, it's about 3 questions. It'll be only about 10-15 seconds. So we will appreciate, because thanks to those surveys, then we can put great content like we just did today. So I don't want to delay it anymore. I think that we cover everything that we need. If there's anything that you guys need from me, hit it on the Q&A widget where you can submit questions, whether it's tech questions or perhaps everything related to the event itself. We'll be taking questions at the end of the event, so make sure that you stay online all the way through. And with that said, I want to hand it over to Theo, who will be moderating today's panel. Thank you so much.
Hi, good morning, everyone. Thank you so much for joining us for this webinar. I'm joined today by our panel. I'll briefly introduce them just by name, and then they can say a brief few words about themselves. Thank you also to everybody joining. We have about 32 countries I see that have registered. 130 companies represented by 32 countries. Our panel today is also kind of dispersed across the globe. Myself and Dewald are in South Africa, Rutger is in the Netherlands, and Nikos is joining us from Greece. So on that note, Nikos Zachariasios is the head of capital management and banking supervision division at Alpha Bank in Greece. Rutger Vroom is the ALM strategy and planning lead and Basel IV project lead at ABN AMRO in the Netherlands. And then Dewald Legrandzi, a long-term colleague of mine, is our senior executive and Basel IV implementation SME at Monocle. And myself, I'm Theo Kum. I'm the business development and research lead, as I mentioned, at Monocle. Nikos, perhaps you can kick us off and just briefly give us, just introduce yourself.
Hello, I'm Nikos Zachariasios. I'm a senior manager. I'm head of capital management bank supervision in Greece, in Alpha Bank. Alpha Bank is one of the 4 systemic banks in Greece. I'm working in various areas in the bank for the last 23 years in areas of capital management, risk management, and also the relationship with the supervisors. Before this, I was working in NatWest Markets in London in the area of risk management. and have been heavily engaged in implementation of the Basel II and also of the other, let's say, regulatory accords, including the new Basel.
Rutger, sorry, I was on mute. Rutger, can you briefly introduce yourself? Thanks.
Yes, certainly. My name is indeed Rutger Vroom. I work at ABN AMRO, one of the largest 3 banks in the Netherlands. I've worked at ABN AMRO for around 8 years now, with a focus on capital and risk management, and worked in various departments. And currently working at ALM Strategy and Planning, which focuses on capital and interest rate risk management. And within that team, I'm leading the preparations for Basel IV. So that covers implementation, but also adjusting the business processes and the business steering in light of Basel IV. So that's it from
Thank you so much. Thanks so much for joining us. Develd, briefly something about yourself.
Yes, thanks, Stu. Yeah, as you've mentioned, I'm a senior executive in Monocle. I have about 10 years of experience doing business analysis, working on data and IT projects, and especially the last 5 years with a specialist focus on regulatory projects. So I've taken quite a liking in Basel regulations and, regulation of the banking industry in general. So, from a knowledge perspective and my experience, that's sort of what I've been doing the last 5 years. Thanks.
Excellent, thank you. I just really want to set the scene for today's discussion. Just briefly share a few thoughts around this. Just bear with me as I figure out. Yeah, I think I understand how to navigate this now. Between the mute button and the PowerPoint button, I think we're finding our way. In December of 2020, the EBA reported that EU banks are facing about a 52 billion capital shortfall in terms of complying with the finalized Basel III reforms, also, as we're referring to here, Basel IV. But many banks tend to focus on their attention on the financial impact of these reforms, citing increased capital requirements, diminishing returns, and potential changes in their business model. All of these very much justified, and I think particularly amplified potentially because of what's happened because of COVID. Banks find themselves having additional demands placed on their resources and capacity, and now they have to deal with Basel IV. And a great deal has been written around Basel IV, around the quantitative side, how to interpret the regulations. Many papers it's been around for a while. Many papers have been written. But for us, a very important point from a Monocle perspective, an often overlooked point, is the notion of how you execute the capabilities needed to do proper regulatory capital calculations, management, and reporting. When I say the implementation, we're not talking about the technical interpretation, we're talking about the technical systems and business implementation of those capabilities. And we see it as a key asset, strategic asset of a business to have that in place. If it's wrong, you feel the pain. If it works well, it's a clear asset as to how you respond and deal with regulatory change. So at Monocle, typically, our role is to translate these complex regulatory requirements and building operationalized, industrialized business processes that enable our clients to be regulatory compliant. And that's very much the kind of focus for today's discussion. And the salient point I'm trying to bring across is that whilst all these other points are exceptionally valid and needs to be debated, and some of these things we will touch on today, if we think about this in reality, the key points is around the execution of it, and hence the topic, effectively operationalizing Basel IV by overcoming the data processes and reporting challenges. And those are the aspects we'll touch on. And some of the key outcomes we are trying to get to. The learning objectives is around how to build a reliable and future-proof kind of system. What are the tangible elements we need to think about this in terms of data cleansing, data quality? We talk about data modeling, and we also speak about the impact of the benefits of these things on the process. And hence, in terms of our esteemed panel, we've got guys representing from executive level, the implementation side, and also the regulatory interpretation side, this is what we will be discussing today. Rick, I think I'm going to kick off the question to our panel. In May of this year, Andrea Enria, the chair of the European Banking Supervisory Board, told the audience in Frankfurt that, let me be very clear, he said, we do not see any benefit in further delays. So I think my opening question, just kind of to set the scene, is where are we with the current legislative process around Basel? What are our expectations around that?
Yeah, so I think that's a very important question when discussing Basel IV is, when will you need to be regulatory compliant to these new regulations? Currently, we still have only a proposal or a standard of the Basel Committee. And currently, I believe in Europe at least, the legislators are preparing a legislative proposal for to update the capital requirements regulation in light of Basel IV. And I think at least our internal expectations are that will see the light of day somewhere at the end of this year. And then you have several years where legislators need to negotiate on and agree on the final legislation and leave probably some time for implementation. What I've generally gotten back from peers and is that people expect a European implementation somewhere in 2024 or 2020 or at the end of 2023.
Okay.
So that would be the dates.
Okay, excellent. Nikos, anything specifically that you guys have kind of dealt with in terms of your interactions with the regulators to date? Do you share a similar view?
Yes, we share similar views. Yes.
Good, excellent. Perhaps on that point, seeing that it is expected, it has been long expected. What are the big ticket changes that we're expecting under Basel IV, and potentially even just considering the kind of impact from a data kind of point of view around this? Perhaps Nikos, you can start us off on that question.
Yeah. First, just to give a little bit of background, as Alpha Bank, we apply for credit risk, which is the big bulk of our risk-weighted assets, is around 90% of our risk-weighted assets are coming from credit risk. We apply the standardized approach. For market risk, we use internal models and VAR and stress VAR. And again, for operational risk, we use the standardized approach. For us, before we go to the implementation of new Basel, the first, let's say, introduction of changes regarding the regulatory framework came from the application of the change in the CRR quick fix, which due to the COVID situation took place in June, last June, which to be honest had the bigger impact in our risk-weighted assets, credit risk-weighted assets, coming particularly for the preferential risk factors for the SME portfolios and the infrastructure. Now, next steps for us is, of course, the implementation of the rest of the Basel. For us, the important part is, of course, the housing portfolio, and which the standardized will become more risk sensitive with the introduction of more bands for LTVs. This would have a positive impact for us. Then we have the participation shares, etc., that is going to have, let's say, a negative impact. And then on the market risk, we move to FRTB, the standardized approach. It's a small, in any case, market risk is not something big for us, so we expect a neutral impact from this. And finally, is the change in operational risk. We are applying, of course, a standardized approach. Now it's going to be no internal models approach for operational risk. So we are working on this, but again, not a big challenge. So effectively, a big bulk of the challenge from the new Basel has been already implemented, and also we have updated our infrastructure in the context of the CRR quick fix, and this would cover also the new Basel.
Okay, good. Yeah. I think when we spoke previously, you mentioned around the kind of like the heavy regulatory burden and the amount of changes required in Greece, that you guys have responded by making these infrastructure changes to kind of deal with it effectively. And I think it very much ties in with the kind of topic we're discussing today around the infrastructure and how that can be an asset. Ritke, anything you would like to add from your side just around how you guys are being impacted from, I believe your approach is different to the standardized?
Yeah, indeed. So I think a key difference for our portfolio is that most of the credit risk RWAs that are impacted by Basel IV are on internal models. So I think around 90% plus our portfolio is on the advanced approach. So for us, Basel IV basically restricts the use of internal models and requires us to do a lot more implementation efforts for standardized approach calculations and for foundation IRB-based calculations. So in the past, there was very much a focus on calculating our RWAs on internal models, and now we have to accommodate, make changes to our infrastructure to make sure that we can facilitate multiple approach calculations, which is one of the big ticket changes for us. In addition, of course, to the reduction in scope for using internal models, which also has a big impact.
And anything in particular around this that is quite specific or nuanced because of the size of the organization, multinational, and the size of a company, of a bank like ABN AMRO that is perhaps extraordinary different?
Well, one thing you of course see is that the requirements on internal models are becoming a lot stricter. Having sizable portfolios and with a sufficient amount of defaults, is kind of a necessity to maintain your internal models, or you need to rely on external data, which is always difficult. Having sufficient scale for your portfolios is definitely an important aspect in making your decisions on Basel IV.
Right. Deval, specifically your side as an implementation practitioner, anything that is kind of like taken a lot of the focus in terms of the work that you've been doing in this regard?
So at the risk of repeating ourselves, I think the other panelists basically already mentioned most of the aspects. So in terms of credit risk, definitely for standardized approach banks, there's more granularity, which means they need to source additional data for, processes and systems that they already have in place. So they need to revisit those sourcing processes, like the LTVs that's already been mentioned, but also with banks on the standardized approach now with a new standardized credit risk assessment approach that Basel has introduced for unrated banks, which will also, push banks that they need to change the way they do ratings for unrated bank counterparties. Then we've seen that the most impact is at the moment at the internal approach banks, especially for credit risk, where not only, as Rutger has mentioned, they get constrained on certain inputs, but they have to do the output floor as well, which means that we need to do a standardized calculation. And we find that a lot of them weren't prepared for the asset classes or the portfolios that were on the internal approach to source standardized data and all the data that's needed for the classifications on the standardized approach. So in a sense, they actually now have to go and build entire new calculations. So some of them were caught a bit off guard. It does mean more data, more processing, and that's sort of in the credit risk space, the major impacts. Then obviously there's things like the CVA calculation that has changed. There's FRTB and op risk, even though those weren't specifically in the Basel finalization paper, a lot of people still see this under the big changes and the Basel IV ambit. So across the board, we're seeing data new data, new calculations, and a lot of these things are sort of putting a lot of strain on the bank's current personnel and their current processes.
Right. Diva, I think whilst we have you kind of addressing the point, what are banks currently, or what would you say, what are banks currently struggling with in terms of their regulatory process, but also then potentially with an eye on Basel? Where do you kind of see some of these pitfalls or the things that guys or banks are struggling with in terms of the execution of their regulatory function in the bank? And perhaps also just with a bit of a focus on the data.
Yeah, so I do think that they're struggling a bit with sort of regulation burnout. There's been a lot of changes in the regulations in the initial Basel III document. There's constant changes, and banks are scrambling to keep up, to update their data, upskill their personnel, to stay ahead of the regulations. So that's one thing we're seeing they struggle with. And in the old days, the view in Basel II was introduced, and there were minor revisions after that. Banks built for Basel II, so in some systems they found that they've built themselves into a corner where adding on the additional capabilities needed for Basel IV becomes difficult. And you're sitting with a legacy process where you're at a point where it's probably better to uproot the entire process and build something new. So they're struggling with the adaptability and flexibility of the current system, as well as with skills, having the skilled people to be able to constantly stay ahead of regulations and implement these things. So I think the adaptability and always having to stay ahead, and then doing things like a QIS exercise that the regulators ask them to do, they find it difficult. And they find it difficult to manage the resources, to find the time and capacity to do all of these things, in addition to the normal task of just reporting on the normal stuff that they need to report on and making normal business decisions.
Okay. Rook, anything you kind of want to add to that point around the kind of like the challenges that you guys, so we spoke about like what's additional, the requirements. What are the kind of like operational execution challenges that you think that you guys are facing?
Yeah, I think that changes a bit over time. So at the initial point, I think the struggles were very much on getting proper impact calculations and the flexibility to play around with that. I think we are now past that point. We have some tactical solutions in place to do that. And then the next step is, how do you look at Basel IV and how do you translate that into your into business decisions? So for which portfolios do you want to make internal models? How do you want to go about making changes to your infrastructure? And I think that once the regulation becomes really final, then that's where you're really going to go into the full implementation mode. So I think we're still a little bit before that point, because as the regulations are not fully final, you basically focus very much on the current regulations to determine what kind of information you need to make the calculations in the future.
Right. I think you raise a very interesting point around how far different organizations are with their journey, specifically considering that it has been finalized. So we'll put a poll question on that shortly just to see how the audience responds to this. Nicolas, just in terms of your readiness around this and kind of your view on some of these challenges, specifically potentially with the readiness or the finalization of it not being done to date, how are you guys addressing it?
The challenge always in these regulatory exercises, but also for internal risk management purposes, is data quality. Our experience as a Greek bank, due to the Greek sovereign crisis, there were a lot of asset quality reviews, on-site inspections, etc., and also driven from the management needs. From, let's say, from 2009 and onwards, we have run a lot of, let's say, processes for improving data quality, for example, particularly for the loan portfolio, for collaterals, etc. And with a lot of effort and investment, we have improved significantly on this. And this is reflected in the current effort in a positive way. In addition to, as discussed for us, the CRR quick fix was a very important, let's say, milestone to achieve. So that's why we invested on the software and all the infrastructure in advance to be able to cover the CRR quick fix which came earlier due to the COVID. So on credit and operational risk, as we see, while effort has to take place, yet we have done, we believe we have covered a significant part of the journey. Regarding market risk, which effectively we are moving to the FRTB, there is a challenge, but it's a different challenge. It's not so much about data quality. It's effectively moving to another approach. Yet FRTB standardized that we are going to follow, at least at the beginning. It's a different concept versus the stress VaR that we apply. So, as I say, following all the efforts we have done in the previous regulatory exercise, we believe that we stand well on this effort for the new Basel. Having said that, and talking generally about the regulatory exercises and not only Basel, there is a significant investment and effort on the various, let's say, data requests, report requests coming from the supervisor, which of course it makes sense at the time, and particularly due to the COVID situation. However, we believe that some optimization of the reporting would allow banks to reduce, let's say, some part of the resources already allocated without in the same time reducing the quality and quantity of data that is currently provided.
Okay. Devald, I know I asked you this question previously. You had quite a strong view around how one should approach not having this finality around this. I think you were quite pragmatic. Just briefly, what was your kind of view on that?
So do you mean about the final stance of the Basel and the regulations and the future prospects?
Yeah.
So like I said, a lot of we find a lot of older processes banks built themselves, like I previously said, into a corner with Basel II, and we've realized that there was Basel III and what people now refer to as Basel IV. So I think it's clear by this time that regulations, they won't really stop. There won't be a final version or now we're done type of scenario. There's going to be always revisions to regulations. The world and the landscape is changing. There's new financial products that's coming up. So we have to adapt, and the regulators are going to adapt. So we need to be aware at this stage that it's going to be a continual process. And that's why we feel banks should get ready to build not just look at Basel IV and try and meet those requirements, but actually look at the process that they are installing. Is that process flexible and adaptable so that whatever comes after Basel IV, whether that's Basel V, whether that's just smaller revisions, can we handle it? And we will probably touch on this later if there's time, but usually a good health measure for your system, your regulatory system and processes is how easy you find it to do a QIS exercise. If for a bank and the regulatory area, it's a burden, and they have to set aside additional resources or a reasonable budget just to quickly do a QIS exercise, which a lot of people view as a throwaway piece of work, then it probably speaks to a system that's not very healthy. In an ideal state, you'd have processes that are easily configurable. You can change inputs, you can run scenarios, and you should be able to do a QAS quite quickly. So that's the sort of message we want to get across, is rethink the entire system. Yes, Basel IV has certain requirements that you can use as sort of your target, but think beyond that and think about the process itself. And build something that's flexible and scalable for the future that meets Basel IV now, but also whatever comes after.
Right. I think this is a good point for us to quickly kind of include our audience. I'm going to push a poll question. Claudia, you must just tell me if I've done it correctly. Yes, it does seem it is. So how far are you with your Basel IV journey? Are you well away, halfway there, early days, not yet started? So I think the system allows a few 30 seconds for you guys to respond. Perhaps just give us your inputs, and I think the rest of the audience will also see the response, or rather the result. On that point, Devald and team, when I joined Monocle many years ago, I received the Basel II Accord, right? And I was told I must understand this thing. It was a ring-bound folder, and I was told this is going to be my new best friend, and I should get to know this. And it turned out to be like that, right? But subsequently, it's been like a blockbuster series. We've had more and more reforms coming out, and this file has become thicker and thicker over the years. We're about 30 years down the line in terms of Basel regulation, right? My question is, what are we not getting right, per se, at this stage? I think, Nikos, you mentioned earlier, there's the data, is the challenges around that. It's around the turnaround time of these things. It's around, Devot, you mentioned the QIS and sometimes the complexity around doing it, the tactical nature, I think with some of the words, Rutger, you use as well. But if I can ask the panel maybe and bring it back to you, Devot, what do you think is currently missing in terms of the functionality and capability that is leading to this gap, if we can call it that?
Yeah, so to touch on the points I previously raised, I do think it's maybe not thinking hard enough about the actual process and thinking too much about just meeting Basel IV requirements and not sticking to a lot of best practices. And a lot of these things are actually things that are outside of Basel. It's just normal. How do you treat your data? How do you set up the architecture and the technology? How do you have which business processes do you have to have in place? A lot of people don't think about those things because they're chasing deadlines and they're understaffed or underskilled, and they're just trying to to reach their goals. So I think it's just maybe taking a step back and building the process that supports Basel IV and beyond. And I think what banks often then miss in that regard is the proper skill set in terms of, yes, having your business people who understand the regulations and what they need to report on, but then also having people who understand all of the technology and the tools you use that enables that. So understand data modeling, understand data principles, and also understand the nature of the data that eventually has to flow through a regulatory calculator. And by that, I mean the product-specific nature. So we often found that there's sort of three core areas. You need to first understand whether you're dealing with derivative products, banking book products, off-balance sheet products. What is a letter of credit and what specific characteristics is needed to sort of transform that into a Basel requirement, which means you also have to understand the Basel requirements. But you also have to build processes that can be automated, that can be audited, and that speeds up your entire process. You need to understand data and technology, and we feel like over those three core competencies, banks either lack one or two of them, or they lack the team that has all three combined in synergy. So a lot of the time they revert to sort of tactical approaches as well, where they do certain elements of it in a certain manner, but the whole system is not always very coherent, and then again that leads to a system that's not adaptable or scalable. So we think that it's basically a skills problem in the one sense, but yeah. So that's my view on it.
Thank you. In terms of the banker's view, do you agree with this? Is there anything that Rutger, for example, you would like to add to this? What do you think is currently missing? Maybe wrong with the current approach?
I think what often happens is that that you start too late with implementing these requirements, and that it becomes then more you end up with quick fixes, and that's always a difficult thing because there's usually quite a short implementation window that you have because between final regulations being published and being required to report on it, that then doesn't leave you a lot of time. But right now you can already think of what Basel IV implies for you and how you can adapt to it, so that at least you know where you need to make the changes in your infrastructure, in your models, and how that's then and where that then fits in your infrastructure going forward. And so making sure that you understand where and what needs to be done, and of course then specifically what is that will come at a later point, but knowing where that has to be done and being ready to do that when all finalities are clear, that really I think helps moving from tactical solutions and band-aid fixes to more structural, proper calculations.
Okay. Maybe, Devil, there's something we can touch on a little bit later on this, how you guys went about and, I mean, almost built the Basel IV process in parallel because you had the flexibility in terms of the system to do that, right? And I think there's some benefits in that we can get to. Just a quick question. Nikos, anything specifically you'd like to add just in terms of your experience around what you think might be missing or some of the root causes as to why we find ourselves in this situation?
I agree with the analysis. First, we discuss about the data quality, data availability. The infrastructure and the solution that a institution would apply is very important and must be proportional to the level of the institution. The wrong infrastructure, the wrong IT solution would create a problem. And this, of course, should be part of the portfolio of the projects that you are running also for internal management purposes, and also try to create solutions that accommodate not only Basel but also internal management purposes. So this is some quick points from my side.
Excellent, thank you. Just so the audience can see, I've shared the results of the initial poll. It seems 9% is well away with the Basel program. 30% is about halfway there. Early days for more than 50%. So that's an interesting statistic. Dewald, I think this is a question specifically I want to address to you, but obviously our colleagues can jump in. We've kind of spoken about the pain points around the change and some of the pain points, basically the symptom, what the banks are feeling because of certain shortcomings. And we've addressed at a high level, we think some of those things are. But what do we recommend? What do you think should be in place specifically, though, to enable this kind of capability? And I just want to kind of caveat or add to that is to Rutger's point saying that there is seldom enough time. There's a bit of a tactical approach to this. I know the kind of approach we take sometimes is saying, well, if you've got a flexible environment that allows you can work with the environment should be such that it's easy to kind of adapt and amend and stay abreast of the changes, because the changes will never end. That's the one thing that is certain. So what are the key capabilities or the things that you advise that should be in place? How do you build that? Because there's a lot of people on the call who are sitting in the same position as Rutger and as Nikos, for example, who now need to affect these changes in the organizations.
Yeah, so obviously we've hammered on the point that we say the system, the overall process from end to end should be flexible and scalable. So maybe it's time to get specific to say what we mean about that. So, as a start off, I would say that, again, you should look at it holistically. You should not look at the Basel or the regulatory space as an isolation. There's certain data practices and, industry best practices that needs to be followed, and it will depend on bank to bank how they integrate with a broader organization. But obviously, as a start off, data would need to be sourced from the rest of the organization and eventually need to be fed through some sort of calculation process and into reports. Often that's done as sort of a, let's just start and do it. But we think if you step back and you break it down into sort of key parts or elements that are sort of modular, where the bank can focus on what they do well and they can take ownership of certain aspects and then maybe outsource certain other elements. We had a slide that I actually discussed the other day that we used as an example. We thought about maybe bringing it up. So maybe if we bring that up, I can talk to it. It will just give people a clearer idea of what I mean when I say, I have components that you, okay, I'm seeing a blank screen now.
Yeah, so when the slide was not supposed to come up, it came up, and now that it is supposed to come up, it's not coming up. So maybe, Claudia, just check it. I think everyone has basically memorized it after the first glitch. Claudia, is there any way, maybe it's on timer again, I'm not sure. Can you see the slide, Claudia? Can you see the slide?
I only see a blank screen for some reason.
I see a blank screen as well. Rutger, can you see the slide?
If she deleted the problem slide.
It's blank.
But yeah, let me continue.
It's a data quality issue. Yes, please maybe just talk us through it.
So basically, on a high level, now again, this won't be true for every organization. Everybody can approach it differently, but basically on a high level, we feel there's sort of three components, right? So data is the core of it. You'll always hear people say data, 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 but we still believe that's true. So we think that it's important that banks get their data correct. And by that, we mean building a data model specifically for regulatory purposes. That will be clear. That will make it easier for business to sort of implement their business rules, to see the process and make the process more transparent, more auditable, to have a clear data model that everybody can understand. And that data model should be catered for, the Basel regulations. And you should source information from various areas in the bank, clean, transform into such a data model. Then the next step will be pushing that into a calculator. Often the mistake is made by either building a calculator in-house or getting a vendor product where the data is then pushed directly into this calculator. And then when the time comes to update this calculator or upgrade it to accommodate new regulations, or in the case of when you have a vendor, when you want to swap out from one vendor to another, then everything is built into that calculator, and you physically need to go and rebuild everything, and it's a massive integration exercise to plug in a new calculator. So we advocate for what we call a agnostic or calculator agnostic data model that the bank owns and the bank manages, which is transparent, well documented, and clear. That can then be easily just mapped into either an in-house calculator or we rather recommend in this case a vendor off-the-shelf vendor product. And the reason I say this is because banks, they always run out of time to implement new regulations, as Rick has also said. It always feels there's not enough time because I think banks are trying to do too much themselves internally. And the pace at which these things happen, it's rapid. So sometimes we should let the people who specialize in certain things do those things. And I think that there's, in the market today, with all the product vendors, there's a plethora of products that you can choose from where they have specialized regulatory products or reporting products. They maintain it. They do the research and the heavy lifting, and they have specialized teams that can look after the things. So it's easier for a bank to maybe outsource that, especially with cloud these days and software as a service. There's a lot of options for banks on the table. So we advocate maybe not attempting to build an in-house calculator, which you then have to maintain and constantly update in light of all of these changing regulations. And then lastly, there will obviously be the reporting. So there will be the regulatory reportings, the reports specific to what the regulator wants, the Pillar 3 reports that everybody across the world needs to populate, as well as some in-house custom reports, whether that's for BI or MI purposes. And again, we think that should again leverage off a common standardized data model. And when you have those three components that's not dependent on each other, it becomes easier to just upgrade one component or one element. And also it makes the entire process a little bit clearer. So that's one sort of just architecture that we advocate and that banks can look at. Now, certain parts of these elements, it's a pity that they can't see it on the screen, but certain of these elements might be
sorry, I think,
where the product
actually think the audio can. Sorry, Deval, to interrupt.
Okay,
I think it's just us. We're not fortunate enough. But hopefully you've memorized your own slides. So if you just continue.
Yeah, so this is an example architecture. We're not proclaiming this is the be-all and end-all, and for every organization it will be different. But in concept, those are the sort of the three elements that we think banks can isolate and focus on, and either one of those can lead to improvements by getting just that right. Okay,
excellent. Now, Deval, just before we give the rest of the panel just a chance to respond to your thoughts, I just want to ask you on the data model itself, and I know you explained something to me previously. You've touched on this briefly, but when it comes to building the data model, I know often we speak to our clients, we say, they have a data model, and you look at the thing, it's a flat file, right? What are just some of the components like to consider the complexity around getting the data model right?
Yeah, I guess it just goes back to proper data skills, having either data analysts and people that are familiar with the concepts and the use of these things. They serve a particular purpose. So in a world where we're hearing a lot about big data and data lakes, a lot of people are sort of against data warehouses. I still believe there's a place for it, a time and a place. And in these sort of specific use cases where you have like a regulatory calculator, any calculator that you need to build will need to consume information in a structured manner. So whether you get it from a vendor, they will have an implicit data model sitting within that calculator, or whether you build the tool yourself. So it's important to stick to proper data modeling principles, normalization, all of those concepts. I don't want to get too technical, but have your fact tables and your dimensions defined. Have all of the concepts and the basic concepts you need for the calculator, have it defined, clearly documented, business rules and user-friendly documents explaining everything. Well, once you have such a process, it makes it clearer of where your data gaps are and what you can change to sort of adjust to various different approaches.
Yeah, I think the one point you mentioned to me earlier that kind of resonated was the importance of somebody who understands the spirit of what is trying to be achieved in the regulation, like what is actually meant by that, and I can translate that to understand the product set, like what it means, and then also what it means, for example, in the data of the organization. Just
yes.
signage convention, for example. That to me is the key thing. You can look at it at face value, but if you don't understand it, you're not going to get the right result, right? You're going to
Exactly. So I mentioned it earlier that obviously to build a data model, you have to understand the target that you're moving towards. So in this case, the target will be inputs to feed a calculator for regulatory purposes. But you also have to understand your source data. So, and then you have to know how to model data. So that sort of touches on what I meant earlier, where there's these three core skills that need to come together. And then once you've built the data model, and you've modeled specifically for the Basel regulations because you understand what you need to achieve, but you also understand your source data, then the heavy lifting is done. And then it becomes easy to plug it into a tool to manage and to run. And if it's well documented, it's also easy to expand and to support. And it doesn't become a tactical solution that causes key man dependencies. And when project team that is implemented it has left, those who need to support it are left in the dark. So that's just sort of the principles we advocate. Yes, proper data modeling, but also documentation that supports the data that you have modeled.
All right. I'm going to push a quick question to the audience, just another poll. It says, does your regulatory capital solution enable frequent quantitative impact studies and ad hoc stress testing? Just kind of give us an idea. Is it fully capable, somewhat capable, not a priority? Rutger, just in response to what David was saying around the kind of key components from a technical point of view, I know you're close to the Basel implementation in your organization. Any specific thoughts on what you feel is kind of like key to the success of this?
Yeah, I think maybe David touched upon it, but one of the key things is indeed getting the right people together and understanding what it's about, and then translating that really to those to that data model and to those data requirements. Like that, I think that's one of the key challenges because that's a skill set that's never contained within one person, and that for us is, I think, one of the key challenges.
Excellent, thank you. Nikos, maybe just before we go to questions, I wanted to ask you briefly, obviously Basel IV doesn't sit in isolation in the bank, and I think you're perhaps well positioned to answer this given all the other work you've done. I know in the Netherlands there's a lot of work going on finance and risk integration projects. There's other larger automation projects. There's credit reform projects going on. How are you guys tying in the Basel IV kind of changes the needs to kind of dovetail or leverage or what's happening in terms of other changes in the regulatory space? In other words, leveraging or the capabilities that might be common.
Yeah.
Nikos, maybe? Yeah, thank you.
Yeah, I'm here. As you said, we have Basel, we have the stress test, we have the EU stress test that has been concluded, to be honest. We have the new default definition. Previously, we had the application of IFRS 9, FRTB, and the other things. We see that in areas in risk management, finance, and business, there is a lot of need for production of reports, either for supervisory purposes or for management purposes. And this, of course, needs investments, needs personnel, etc. From our side, we are trying to evaluate synergies between the various reporting streams, let's say. And we are trying to adopt a common, let's say, data/reporting services in order to exploit these synergies and to optimize where possible, the let's say the resources and let's say infrastructure and effort that is taking place. So this is something that we are looking at, and we are trying to progress on this.
Thank you for that input. I've just put up the results from the poll so the audience can see that. Just in the interest of time, I won't talk through that. Perhaps I think it's a good time to go to Q&A with a few minutes left to go. In terms of the panel, I don't know if you can see the Q&A box there. Any you guys have managed to look at? I'm just seeing one here. Just want to confirm, can you guys all see the panel? The Q&A box?
Okay, yeah, I see it now.
Good. Then I don't want to surprise you with a question. Anything specifically? Good. Let me perhaps pick one here. Diego is asking, could you also mention delays on the EBA side, in particular with RTS, which are mandated by the CRR2 and which are already late? Is that something, Rutger? It's question 7. Is it something you're comfortable answering? Are you able to scroll?
I don't know the specifics of those RTSs.
Okay. Good. No, it's fine. Nikos, anything? Are you familiar with the specifics around question 7?
1 second. Looking at the question. Is there a specific, because we have RTS for few things, and there were some RTSs, for example, for in the context of CRR, for example, how the software is treated, etc. So we have RTS that are coming on time. We have some RTSs that take more time. For example, the RTS for software took some time in order to be concluded. So, it depends, how, what particular RTS somebody has in mind.
Okay. I think perhaps with a lack of information around that, we should move on. Good. So we've got 2 interesting questions from Ravi Kiran. The first one is, considering the cost of technical implementation and strict regulatory requirements on the internal models, is it really worth spending a lot of effort on internal model approach instead of relying fully on a standardized approach? I know capital requirements could be a bit on the higher side. How do you decide upon the strategy? So that's the first question. And then the second question is, to reduce the impact due to non-modelable risk factors, how do we ensure that we have reliable market data which could pass risk factor eligibility tests? Do we rely fully on market data vendors or regulators, or can fellow banks work together for data availability? That's from Ravi Kiran. Who would like to take that question?
Yeah, I'll have a go at it. So I think it's a very good question. The first one is obviously something that banks would immediately have been faced with when they heard about the output floor. So this will all depend obviously on the portfolio and the specific product mix that the bank has. So yes, in a certain instance, banks will need to do 2 calculations. They'll need to do standardized calculations. So if there's not that much benefit in an internal model, is it still worth maintaining it? Banks also need to note that it's not always just so granular that the moment for a certain asset class or a certain risk class that you calculate where the floor is breached, then you have to revert to the floor. A lot of the floor is sort of on a portfolio basis. There are some cases, especially in credit risk, where it's very specific to your asset classes, but it's not necessarily to say that in one area, if you breach the floor, that you won't be allowed to breach the floor there, as long as your overall portfolio level capital is still, your internally calculated capital is still higher than the floor on an overall basis. So that's just one thing that banks need to be aware of. And then also that, it depends on exactly how good your models are and how much gain you get versus the operational cost of having those internal models. So the capital is just one factor. So if there's a clear gain in capital, yes, it can look promising, but an internal model is usually a lot more operationally expensive to run. So banks also have to weigh, the fact that should we support these internal models alongside still standardized model for whatever small benefit we have, and then there might be incentive to just move to the standardized approach. So yes, we might see that happening. And again, how do you decide on the strategy? Well, that depends on the specific mix of the products and the portfolio that each respective bank has. And then moving on to the second question. So obviously this one is more framed towards market risk and the FRTB, where the non-modelable risk factors are the crucial element, or the one element that banks fear the most. It will, especially in the beginning, be a big driver of the increase of capital. We do expect that obviously after implementation, as banks move along, they can target that component and start reducing it to get it lower, but they will need information and they will need the correct market data. And this is something that we're also seeing from other regulations. The regulations driving the reporting to regulatory repositories and trade repositories. There's going to be a lot of elements that banks now need to report on, and additional information that they need that they might not necessarily have themselves. They might sit with some of that information, especially the banks that are in their capacity as market makers, but this provides incentive for banks to really start working together. Banks, especially in the same jurisdiction and area, can really start talking to each other and share their information, rather than all of them going to maybe a market vendor. But I do still believe there will be certain specialized data that market vendors will collect, and they will standardize, and depending on the licensing for that data and the volumes that you require, banks can decide whether they should be going to vendors, or whether it would be just better to just work together within their jurisdiction. So that is something that I think will start materializing as these regulations start getting implemented by the various banks.
Thank you, Deval, for those insights. Then another question, perhaps a final one, from Harold. Harold writes, credit risk. How do you address the issue of cross-collateralization of exposures with various collaterals, for example, two real estates, CRE and RRE, so that's commercial and residential, for the same exposure? Who would like to take that question?
Yeah, actually, I'd like to have a go at this one, because I think this is a very good question and something that I wish we could have explored if we had more time in the webinar. But basically, this is something that we've seen in practice, is that there's often a case of multiple pieces of collateral and even guarantees marked to the same exposures. And this is where having the correct calculator and having a capable tool with inbuilt collateral or CRM optimization will be of massive value to a bank. Usually when banks build in-house tools, they don't think of these situations, and these things need to be addressed before the calculation. But when you have a good calculator that is flexible and scalable, they can often do the optimization for you. So you can, depending on the asset class, map multiple collaterals and even guarantees to multiple exposures. So it can be in a multi-to-multi mapping. And then the tool will actually evaluate which mix of actual collateral allocation to the exposure would result in the best capital outcome. So that's definitely, and we've seen vendor tools that can provide that capability with great speed. So that's where we sort of also advocate to do your due diligence when you choose a calculator, and to choose the correct one with the correct capabilities. For certain asset classes, especially the real estate ones, as mentioned in this question, it's not always as clear cut, because a lot of the collateral is sort of intrinsic to the exposure, especially where LTV ratios are involved. So then you might need to explicitly already, before you get to the calculation phase, know where the collateral is going to end up and decide to which exposure or tranche you need to allocate the collateral. And that's where, again, if you have a good data model, it's clear, it's easy to navigate your data, and business users can make these decisions to decide where they think the best will end up. Otherwise, again, at the end of the day, the best would be, especially if you have very, very large portfolios, push it through to a calculator, have it do its optimizations and see what comes out. Alternatively, have a good data model so that you can preempt some of these things beforehand.
Good. Thank you for that insight. Much appreciated. Deval, is there a specific question that you found?
Yes, so I'm looking at question, one of the questions posed here by Ferreira de Priya around calculating the output floor for residential real estate, and the need to classify between general residential real estate and income producing residential real estate. So as we know, with the Basel IV regulations, there's a lot more granularity for standardized approaches in terms of your real estate asset class with loan to value ratios. So there is going to be a burden to source new data and to improve your data sourcing. And that's why we believe that if you have a data model that's independent from your calculator that sits in between, it's easier to follow up on missing data, to have data quality sitting on top of that data model so that you can go back to your source and you can implement SLAs with whichever the source is that gives you the information. In the case of the question is asked here, when you have missing data, what do you do about it? So one thing is obviously you shouldn't just deal with it and move on. You should deal at the root cause. So that's why I'm advocating for data quality sitting on top of a well-built data model so that you can actually resolve data issues and get your source to provide and update the information more frequently. But to address his question specifically, in the event of missing data, it's basically, yes, you'll generally resort to the most conservative measure. So you'll have defaults in place, and if you don't know which one to classify between the two, you'll basically choose the most conservative matter. That's just a prudent best practice approach. Obviously, you find cases where people will try to sort of use the more advantageous one, but that's a bit, we won't recommend that. So yeah, so I hope I've answered that question correctly.
Excellent. Rutger or Nicholas, anything you guys want to add on that question, or shall we move to another one? I'm just going to push our last poll to the audience whilst we just collect our thoughts over here. This is quite a practical one that we got from Konstantinos. He's saying, looking at the results of the poll and considering that we don't even have the finalization of the rules for the EU level, do you believe that the banks will be able to adopt Basel IV at the beginning of 2024? Don't you think the timeframes are too demanding? It's a bit of a qualitative question, but just in terms of your view, Rutger, around that, do you think it's too late? Do you think we have enough time? Are we doomed? What's your stance?
I think that will definitely be demanding. And what you can imagine, of course, is that that there will be a fractured implementation or that of Basel IV, so meaning that only parts will be implemented, or that there will be scaling in the timeline so that certain parts allow for a longer implementation timeline. I think that will be quite that's quite a likely scenario, but it's also dependent on how quickly the finalization at EU level runs.
Okay, I think the results of the poll kind of almost provides the answer to the problem. Is that 70% of the people say that the problem is about around their challenge is around the operationalization of systems and data modeling. Devil, I think it speaks specifically to the point you made earlier, right? That a lot can be done.
Exactly.
Designers, right? You're running Basel IV already in terms of your projects. You're running the QISs. You've got a benchmark in place, a delta from which you can, or a baseline from which to do deltas. Rutger, I think when we spoke offline, you explained that you guys are following similar things where that allows you to identify the gaps. But if you've got that framework already in place, that flexibility does set you up for Basel IV and, dare I say, Basel V. Good. Guys, we're basically out of time. I was just going to ask maybe each of you just a final thought, a word of advice, points to ponder in closing that the audience can take away as a practical consideration as we say goodbye. Rutger, from your side?
Yeah, I think at least that's how we're trying to look at it within AMRO, is that we're trying to use Basel IV as a lens to look at how in the future capital requirements will be calculated and what will be required from us for that. And yeah, base your implementation efforts on those on that lens. That definitely improves the decision making on that.
Excellent. Thank you. Thank you, Rutger, for your input today. And Devald, your thoughts?
Yeah, so to sort of tie what Rutger said and maybe just take a little bit of a different view, I also think that banks should really, really look beyond Basel IV. We've just mentioned that, well, the topic of this conversation broadly revolved around Basel IV, but I think Basel IV should just be an example. So banks should really look beyond, look at the system itself and not just meeting the short-term Basel requirements. But I do think Basel IV can really be used in the bank, at least, as a leverage point to get budget, to implement the system. Because regulations, they have to be, banks have to do them. So it's easy to motivate if you're in that area to get the budget to implement a project, but then don't just look at Basel IV. build a future-proof system that can also go beyond Basel IV. So that's, again, just my closing remarks.
Excellent. I'll give the final panel view just to word to Nikos. Your final tips or thoughts?
I think that the evolution of the regulatory accords Basel IV, it's very important for institutions. For us, applying the standardized approach, it becomes more risk sensitive. So for us, it's better to align with the capital allocation and the pricing. It's important the use test. So effectively, you do the Basel not only for reporting the capital requirements, but also try to align what you are doing with your internal risk management processes and take decisions based on this.
Thank you very much to our panel. And also thank you to everybody joining. I'm going to give the final word to Claudia to just close us out. But if anyone wants to connect, please connect with us on LinkedIn, and we can continue the conversation. We'll look at some of the unanswered questions as well and see how we can respond. If somebody wants to get in touch, my details will be at the end. Maybe we can discuss your Basel journey further offline. Thank you, everyone, for joining. Claudia, I'll hand it back to you.
Thank you. And I just want to quickly apologize for the technical issue we had today. So I'm sorry about that. But in any case, the event has been recorded. We will edit out those minor technical issues. And then what we do, we send out in the next 2 hours a link for you to all to watch the recording. So yeah, so on behalf of Marcus Evans, Monaco, we would like to thank you all. And we will leave you with a quick video. And in the meantime, you should be able to see on your screen a quick survey for you all to be able to answer. So with that, I'll push out today the video to you all, and I'll be catching up very soon.
Thank you, everyone. Goodbye.
Visit monoclesolutions.com for more information. From Johannesburg to London, Cape Town to Amsterdam, Monocle, we design change.